We're all taught to think of profit as this hard, solid fact. It's the bottom line, right? But what if I told you it's not a fact at all? What if it's actually more like an opinion, a really carefully constructed story? Well, today, we're going to peel back the layers and see how profit is really calculated.
So here it is, the big puzzle that trips up almost everyone. You'd think that if a company is raking in profits, its bank account should just be overflowing with cash, right? And if it's losing money, that cash balance should be dropping. But believe it or not, so often the exact opposite happens. What in the world is going on here?
And this isn't just some textbook theory. Look at this, a real-world case with Amazon. In 1 year, they reported a massive loss, almost $750 million. You'd expect their cash to take a nosedive. But instead, their cash balance actually went up by over $91 million. How is that even possible? Well, the answer is hiding in a couple of really powerful accounting concepts.
All right, the first clue to solving this whole mystery comes down to one simple thing: timing. It turns out it's not just about if money changes hands, but when you actually count it.
See, to really get this, you need to know there are two different ways to tell a company's financial story. The first one is super simple, cash basis. Money comes in, you write it down. Money goes out, you write it down. It's easy, sure, but it can give you a pretty warped view of what's really happening. That's why most big companies use something called accrual basis. And this, my friends, is where the magic and all the complexity really begins.
So what is accrual accounting? Well, at its heart, it's trying to give you a true picture of a company's performance during a certain time, whether or not cash has actually moved. It's about capturing the real economic pulse of the business. I mean, think about it. A company could be insanely busy, earning tons of money, but still be waiting for its customers to actually pay up. Accrual accounting is what lets us see that reality.
And the absolute golden rule of accrual accounting is this thing called the matching principle. Just think of it like this. If you spend a bunch of money on an ad campaign in March to generate sales in March, you have to record that ad expense in March. You match the effort, that's the expense, with the reward, the revenue. It just gives you a much, much clearer picture of how profitable you were that month.
Here's a perfect way to see it in action. Let's say a landscaping company sells a big mower to a client on credit. They've done the work, they've delivered the product, they've earned that money. So under accrual accounting, they book that sale right away. The fact that the cash might not show up until next month doesn't change what actually happened this month. That's the power of timing.
Okay, so timing is the first big piece of the puzzle. But the second piece, well, this is where a huge plot twist comes in: human judgment. To make this whole accrual thing work, accountants have to play what I call the estimate game.
I just love this quote. It really nails it. Your accountant isn't a mind reader, right? They don't have a crystal ball. So to properly match those revenues and expenses, they have to make their best educated guess. They have to rely on estimates.
And these estimates are everywhere in a company's financial reports, just hiding in plain sight. Think about it. How long is a brand new piece of factory equipment really going to last? 5 years? 10? That decision directly impacts how much expense they record each year. Or what about customers who never pay their bills? The company has to guess what percentage of their sales will go uncollected. Every single one of these judgments changes the final profit number you see.
Now, you might be thinking, are they just pulling these numbers out of thin air? And the answer is no, not at all. It's a structured process. Accountants look at what's happened in the past, they compare it to others in their industry, and they factor in anything they know about the future. It's all about making the most reasonable guess possible. But, and this is key, it is still a guess.
Okay, so this is where things get really interesting. If that final profit number depends on choices about timing and on a bunch of estimates, well, that means managers have some power to influence that number. They can actually manage the story the company tells.
And this creates a very, very fine line. On one side, you have something called earnings management. This is where companies use the built-in flexibility in the accounting rules, it's called GAAP, to kind of put their best foot forward. It's a bit of a gray area. But on the other side, you have earnings manipulation. This is where a company intentionally breaks the rules to fool people. And that's not a gray area. That is straight-up fraud.
So why would anyone do this? Well, the incentives are just massive. Hitting those Wall Street profit targets can make your stock price skyrocket. It can unlock huge bonuses for the executives. A company that looks more profitable can get a loan more easily or get a much higher price if it's being sold. The pressure is immense.
If you want a jaw-dropping example of what happens when that line is crossed, look no further than the case of Homex. This was a home-building company that claimed it had earned revenue from selling over 100,000 homes. Just one tiny problem: those homes hadn't been built yet. In fact, they didn't exist at all.
And here is the absolute kicker. The fraud was so big, you could see it from space. Seriously, satellite pictures later confirmed that the land where all these homes were supposedly built and sold was still just empty dirt. This wasn't some aggressive estimate, it was a complete fantasy.
So, let's put all the pieces together. We've seen how timing rules and human estimates can create this big gap between the profit a company reports and the cash it actually has. And what that means for us is that we have to learn to read between the lines of those financial reports.
So, what's the big takeaway from all this? It's that profit is not some simple number that a calculator spits out. It's a construction. It's this blend of how the company is actually doing mixed with dozens of tiny judgments made by its managers. Every financial statement is telling you a story, and now you know how the authors are shaping that story.
So the next time you see a headline about a company's quarterly earnings, I want you to pause. Don't just see the number. Ask yourself, okay, what choices about timing went into this? What kinds of estimates are buried in there? What story are they trying to tell me? Because now you have the tools to read it with a much sharper, more critical eye.